Cloud computing is one of the massive industries that is expected to have a long-term, strong growth tailwind as more and more of the world moves to cloud. The industry is dominated by the big names Amazon, Microsoft, Google. If you're a multi-billion-dollar company that needs cloud services, chances are you're using one of AWS, Azure, or Google Cloud Platform. Disrupting these businesses and winning large enterprise customers is going to be pretty tough because they're already trying to do it to each other. The company I'm analysing today is DigitalOcean, who are taking the novel approach of aiming at individuals, startups, and small and medium-sized businesses. The strategy is targeting the underserved with a more specific approach, which is a common strategy seen across a lot of businesses. Basically, the areas that the big boys struggle to make specific offerings for. DigitalOcean plans can be as cheap as $5 and are designed to scale with the customer. In the Q2 releases, the company announced it had over 600,000 customers around the world. One of the biggest strengths of DigitalOcean is that it really lacks customer concentration. Such a large pool of customers is a powerful protection against loss of business that larger cloud companies can experience. For example, Fastly, when it lost TikTok, suffered a big decline in revenue growth and stock price. September has been a fantastic month for the stock. It's up about 30%, with the company now at near all-time highs. Right now, DigitalOcean is about a $9.5 billion company with $420 million in annual recurring revenue. This gives the business price to sales multiple of around 26 times trailing sales. Not cheap by any means, but all signs are looking up. Revenue growth is accelerating, up about 35% year over year, compared with the 2020 average growth of around 20%. Net dollar retention rate is 113%, and average revenue per customer is up 25%, meaning that the classic land and expand growth policy is clearly working. As mentioned before, DigitalOcean wants to scale with its customers, and this is clearly working. The market for cloud computing is for small and medium businesses alone is predicted to grow to $110 billion by 2025. With not even $500 million in annual recurring revenue, DigitalOcean has barely touched its huge and expanding total addressable market. Not selling for just organic growth, the company recently purchased a company called Nimbella. Nimbella is a serverless platform provider popular amongst individual developers mainly. I absolutely love this move for DigitalOcean. The acquisition of what is a function as a service company like Nimbella shows the company is moving towards a similar model to the large cloud computing companies. So I don't know much about serverless computing, but I know that AWS started the trend by offering AWS Lambda, which is a similar offering to Nimbella. And this was followed by Google, Microsoft, and Oracle. This is all about improving the experience for its customers, in this case specifically individual developers. This is a great precedent, I absolutely love it. This is exactly the type of acquisition I believe a company like DigitalOcean should be making. Rather than attempting to acquire a competitor to buy customers, they're buying features, they're improving their offering, much like Square has recently done with Afterpay. They could have built it, but it's much easier and much better to buy it if the price is right and buy the associated IP with that. If they're going to compete with some of the big names, they will need a competitive offering. Of course, the stock is definitely not risk-free. The valuation is quite high, around 26 times sales for a company that's growing 30% year over year. Valuations like this always create inherent risk in the short term. You know, the winds of the wider market can come and go and are subject to change. In the long term, a lofty short-term valuation shouldn't matter and is something that I don't ignore, but it will not keep me out of a great business. You know, as Ben Graham, Warren Buffett's mentor, once said, in the short term, the market is a popularity machine, and in the long term, it's a weighing machine. I believe in the long term, winners win. I definitely think DigitalOcean is starting to show that it's a winner. I started buying DigitalOcean around $57, and I'm still averaging down at the current price in the 90s. In my opinion, the much greater risk to the business here is that the market is being ate up by bigger players. This is often a risk for disruptors. Like, the market is definitely big enough for multiple winners. We're already seeing AWS, Azure, Google Cloud, Oracle, IBM. They all have a slice of the pie in North America. DigitalOcean is doing a great job And there's definitely plenty of room for small players to eat up small customers and try and build with them. And I really don't see this trend slowing down anytime soon. Looking at the graph, you can see that as of right now, DigitalOcean is absolutely dwarfed by the big players and in terms of market share, and this is likely going to continue. But having said that, the company is still producing over 400 million in annual recurring revenue from a really diverse and reliable range of customers, and is growing at 30% annually. DigitalOcean does not need to win this market. A small, specialized niche player in an enormous market with long-term tailwinds can be a huge winner. I see DigitalOcean being a much, much bigger company in 5 or 10 years if it continues to execute the way it's doing and accelerate its growth. I'm really excited to follow the journey as a shareholder, and I hope you will be too. Thank you.